Our next section is how to account for accounts receivable. Well, the first thing we can ask is, what is accounts receivable? An accounts receivable is basically amounts due from customers. So as we can see here, ABC Company sells products or services to the customer that the customer receives, and in exchange the customer provides the company an obligation to pay cash. And so ABC Company, they now have a legal right to this cash, and the legal right is called accounts receivable, and it is an asset on the balance sheet. And here we have just the formal definitions. Accounts receivable is amounts due from customers that A, are expected to be collected in cash, and B, have resulted from the sale of goods or services. Now, some other items come into play with accounts receivable: write-offs and bad debt expense. So a write-off would be removing a customer's receivable from the accounting records because it's considered uncollectible. So we have a receivable of $100 from John Smith. John Smith has gone bankrupt. We know we're not going to collect that cash anymore. So what we go ahead and do is write off that receivable. Now, bad debt expense is a selling expense caused by uncollectible accounts. So ultimately, we're going to call these uncollectible amounts an expense because they are going to eat away at our profit. So the first and easiest accounting entry we can make when it comes to accounts receivable is the entry when we have sold the goods or the services to the customer. So as you can see in this case, we're debiting accounts receivable, $1,000, and we're crediting sales revenue. And it could be services revenue if what we have sold is services. Here we see that accounts receivable actually show up in the balance sheet in the assets section. And the reason that they're an asset is because the definition of an asset is essentially probable future benefits to the company. And since accounts receivable represent the legal right of the company to receive cash in the future, well, that's certainly a future benefit for the company. The next thing we're going to look at is how do we account for those uncollectible accounts? Those accounts where we believe the customer is probably never going to pay us the cash. And there are two methods, the direct write-off method and the allowance method. We'll start with the direct write-off method because it's the easiest one. And as the bullet here says, the direct write-off method means we're recording bad debt expense when we write off the individual receivable. And the key there is when, so the timing. When we believe the customer is not going to pay us, at that time, we go ahead and record bad debt expense. And as you can see here in the journal entry, we just debit bad debt expense and credit accounts receivable. The second method we're going to look at for accounting for uncollectible accounts is called the allowance method. Now, this is very different from the direct write-off method. With the direct write-off method, we waited until we were able to identify individual customers that we believed were never going to pay us the cash they owed. And when we identified them at that moment, we recorded bad debt expense. And then, of course, we reduced the accounts receivable. We wrote that off. Under the allowance method, as you can see here in the top bullet, we record bad debt expense when we calculate an estimate of the amount of uncollectible accounts. And typically, this estimate is performed at the end of a period. So keyword, we're making an estimate. We don't know for sure at the end of the period who's going to pay us and who isn't, but we do make an estimate. And as you can see there in the equation, the estimate in this case would be the $500. So we make the estimate of the total $10,000 of accounts receivable. How much of it do we believe we're never going to collect the cash on? Well, we're going to estimate $500. We record that in an account called allowance for doubtful accounts. And so then if we subtract the $500 from the $10,000, we get something called net realizable value, as you see there, which of course represents, of the total 10,000, we believe we'll ultimately collect 9,500. So moving down to step 1, what we need to do with the allowance method first is we need to calculate our estimate for uncollectible accounts. And there are 2 methods for doing this. We'll look at both of those methods. Once we've made that estimate, step 2 is to go ahead and record an adjustment in the books for the estimate we've made. So under the allowance method, there are 2 ways to calculate our estimated uncollectible accounts. The first is this percentage of sales method. All we do here, as it says, is calculate estimated uncollectible accounts by multiplying the percentage of estimated uncollectible accounts by annual sales. So we come up with a percentage, then we multiply that by sales. In this example, we estimated that uncollectible accounts were 1% of sales of $50,000. So 1% of $50,000 is $500. So that was our estimate. We plugged that in there. From $10,000 of accounts receivable, we subtracted the $500 of allowance for doubtful accounts to get to the net realizable value of $9,500. Again, the $9,500, that's the amount we ultimately expect we will collect. Then at the bottom, to go ahead and record that in the general ledger, all we have to do is debit bad debt expense, $500, and then we credit the allowance for doubtful accounts account for $500 as well. Under the allowance method, the second way to calculate our estimated uncollectible accounts is the aging method. All we do, as it says here, is calculate estimated uncollectible accounts using an aging schedule. And this is a very simple example of an aging schedule. What we do is we start at the left, and we notice that the schedule is actually on a customer level. Each customer has their own row. In the balance column, this is the total balance that the customer owes us. Now, some of that amount could be current. In other words, it's not past due. Some of that balance could be past due, and it could be a certain number of days past due. Any one of these that we'll call buckets. Day 1 through 30 is a bucket past due, and so on and so forth. So we can see here that J. Smith, his entire balance is current. A. Johnson, the entire balance of $250, 50 of it's current, 100 of it is past due, 31 to 60 days. And then the last 100 of it is very, very overdue. D. Turner, of the total $300 balance, 75 is current, 75 is past due 1 to 30 days, and then the remaining 150 is past due 61 to 90 days. We have a subtotal row here, which just adds up the numbers above it. So the total balance that all customers owe us is $650, but only $225 of that is current. 75 is past due 1 to 30 days. 100 is past due 31 to 60 days. 150 is past due 61 to 90 days. And then 100 is past due 91 to 180 days. The next thing we do is we assign this estimated uncollectible percentage to each of our buckets. And it makes sense. The older or the more aged the receivable is, the more we would expect that we're not going to collect the cash on it. So with our current bucket, we've said we expect to collect almost all of that. Only 2% we do expect will be uncollectible. And then we move on up as we go to the right. If it's past due 1 to 30 days, we're going to guess or estimate 10% of that it will be uncollectible, and 90% of it we will collect. So on and so forth. 25% for the next bucket, 50%. And then for the last bucket, we're estimating we're not going to collect any of that. This next row, estimated uncollectible amount, all it does is multiplies the total for that bucket by the percentage that we've assigned to the bucket for uncollectible to get to the dollar value of uncollectible. And that's done separately for each of the buckets, as you see here. And then if we sum all the buckets, we come down to this total estimated uncollectible amount. So this is for all of our customers based on these aging buckets and the percentages we've assigned to each bucket. We believe that $212 of the total accounts receivable, we will never collect it. Now, with the aging method, the second thing we have to do after we've prepared the aging schedule on the previous slide, and we came up with that $212 that we estimated would be uncollectible, the next thing we have to do is go ahead and make an adjustment to the books that reflects this estimate that we have. So what we actually do is we take the allowance for doubtful accounts account, and we say, what is the ending balance that we want to be in that account as of the end of the period, in this case, the end of December? We look at what we started with before the adjustment. In this case, it was only $100, and we say, what adjustment is needed to get to the $212? So in this case, it would be $112. Once we've calculated the $112, we book an adjustment just for that $112. We debit bad debt expense, and we credit allowance for doubtful accounts. The next thing that we can ask under the allowance method is, how do we write off an uncollectible account? So one of our customers, we have realized, hey, this person is never going to pay us the cash they owe, and we realize we need to adjust the books accordingly. So as you can see here in the top box, we debit allowance for doubtful accounts, and we credit accounts receivable for that amount. Now, if you notice at the box below, when we write off a customer's account balance, it actually has a zero effect on the net realizable value of accounts receivable. So before we made the adjustment, we started here with our existing balance of accounts receivable, $10,000, like we saw earlier. We did have this estimated allowance for doubtful accounts. We didn't think we were ever going to collect that portion. And we had a net realizable value of $9,500. This was the amount we believed we would collect eventually. Well, when we do the write-off and we decrease the accounts receivable balance, but we also decrease, which is a debit, to the allowance for doubtful accounts account, the net effect that that has to the net realizable value is zero. So the new balance after adjustment remains the same net realizable value of $9,500. The only difference is if we look at the accounts receivable balance itself, yes, it has gone down 50. And then if we look at the allowance for doubtful accounts account balance itself, it has also gone down 50, so it's only $450. So now we're subtracting $99.50. We're starting with $99.50. We're subtracting $450 to arrive at $9,500.